transient. In fact, it's getting worse.
It's getting worse.
That's the situation as of today.
We thought it might start to come down, that month-over-month number, which in a way is more important if you're looking at a trend, and that's still moving in the wrong direction.
Left-hand side of your screen, ladies and gentlemen, this is how the stock market's shaping up after those pretty bad, I'd say, inflation numbers. Michael Lee is here with us this morning. Michael, I'm looking at the NASDAQ. It is way, way down. You're not bullish on big tech today, are you?
Well, Stuart, this is probably the time to start looking at some names that have been beaten up and to start looking in here. I think the reaction you're seeing in the markets, I think you've had a rally over the last week that's been pretty strong, particularly yesterday and earlier this week.
Wait a minute, Michael. You got come on. You got to address this. 7.5% inflation over the past year, and a Fed which has got to do something about it. You're telling me to go in there and buy stocks before we know what the Fed is going to do about this 1.99% yield on the 10-year Treasury. Wouldn't it be extremely dangerous to jump in today?
Well, Stuart, these are the days that you want to jump in, and what you're seeing in the market, and I think the rally that we've seen over kind of the last few weeks from the lows of the year is they were expecting a much better number today and for inflation to cool. Inflation did not cool in this number. The month-over-month and year-over-year numbers will improve over the year. That doesn't mean prices are going to come down, but the odds of the Fed going 50 basis points in March went from about 25 to 30% before this print to over 50% after that print. There's rumors out there, not rumors, but the Fed Fund Futures briefly predicted 6 rate hikes this year from 4 after this print. So when there is this much this far-ranging of views of what the Fed's going to do, you're going to have markets all over the place. I think we are still mid-cycle, and many say, and it's said that the Fed kills the bull market, the Fed kills the economy. That's not true. Debt bubbles kill the economy, and the Fed leads to the bursting of those debt bubbles. We're not there yet. The Fed is going to have to be active throughout the next 6 to 9 months to show that they're serious. Okay, but at that point, you're going to see much lower year-over-year numbers from a combination of things happening. Higher base effects, meaning... Go ahead.
No, I'm sorry. I understand where you're coming from, but I'm extremely nervous about buying into a stock market at these high levels when the Federal Reserve, is going to raise interest rates. And you can't be sure that inflation will come down significantly. I'm sorry, Michael, I've got to leave it there, and I shouldn't do that to you. You should have the last word. But, I'm out of time. I'm very sorry, Michael. Such is life. Okay?
No problem, Stuart.
I've got to move on. Here we go.